Hi everyone, thank you for joining us today. My name is Kathleen Lovito and I will be your host for today's webinar, What the Tax Reform Means for Your Military Family. Joining me today are Brittany Benassi, Vice President of Financial Planning for AAFMAA Wealth Management and Trust, and Taylor Stephenson, Partner at TRP CPAs. Our presentation today is expected to last approximately 30 minutes. We conclude with a question and answer session. If you have a question, please feel free to reach out to us by email. If you didn't get a chance to jot down the email addresses for Brittany and Taylor on the screen, we'll show the slide again during Q&A, and you can download a copy of these slides now from your webinar control panel. This monthly webinar series is brought to you by AAFMAA Wealth Management and Trust. Our vision is to ensure the financial security and independence of members of the Armed Forces community, active, retired, honorably discharged service members, and their families. We accomplish this by being the premier provider of financial planning, investment management, and trust services for all branches of the military. We are AAFMAA's trust company. AAFMAA stands for American Armed Forces Mutual Aid Association. AAFMAA, created in 1879, is the longest-standing, not-for-profit association exclusively serving the military. We empower military families with affordable financial solutions. AAFMAA focuses exclusively on the needs of military families and provides innovative, personalized, and lifestyle approaches of appropriate financial services. A key point that sets AAFMAA Wealth Management and Trust apart from other companies is that we are a fiduciary. What that means is we have a legal obligation to act in your best interest and for your benefit. One important disclaimer before we begin this month's webinar. The information presented herein was compiled from sources believed to be reliable. This presentation is for educational purposes and is furnished with reasonability for completeness or accuracy. It's general information and is not specific investment, legal, or tax advice for any individual. Do not rely on this presentation alone to guide your financial planning decisions. Since each individual situation is unique, your needs for financial services will differ. For individual advice, please contact us directly. We produce this webinar series in-house with our own professional staff as a service to our members and to help better understand the resources that are available to them. I will now turn it over to Taylor and Brittany for the presentation.
Thanks, Kathleen. Before we begin talking about the new tax law, I wanted to take just a minute to tell you about my firm, TRP CPAs. Our firm was started in 1972 and now maintains 3 offices in Fayetteville, Dunn, and Sanford, North Carolina. While we are physically located in North Carolina, we serve clients all over the country. Our mission is to help our clients achieve success by providing personalized attention with a commitment to service. Our aim is to be where business is going rather than where it has been, and to develop the technology and the people to do it. We largely serve closely held businesses, nonprofits, and individuals. Some of the types of services we provide are accounting and bookkeeping services, financial statement preparation services, auditing, tax preparation, planning and consulting, and general business consulting and advisory services. So let's get started talking about the new tax law. Congress recently approved major tax reform with the Tax Cuts and Jobs Act, which was passed on December 22, 2017. This act is the largest overhaul of the U.S. tax code in over 3 decades. By now, almost everyone has heard of some of the provisions of the new tax law. What you may not be clear on is how this tax reform will specifically impact you. Hopefully, our presentation today will provide you with a better understanding of how the new tax law will affect you, your business, and your estate. Most of the changes will be effective for the 2018 tax year. However, there are a few changes that went into effect prior to 2018, and we will cover these in our presentation. Let's first talk about the changes that will impact individual taxpayers. As shown in this slide, the new Tax Reform Law Act created new individual tax brackets and rates for 2018. There are still 7 federal income tax brackets, but most individual income tax rates are lowered, and the income levels have been adjusted. The top marginal rate drops from 39.6% to 37%. The bottom rate remains at 10%, but it covers twice the amount of income compared to the previous brackets. Another major change is the near doubling of the standard deduction. The standard deduction for single filers was previously $6,500 and will now be $12,000. For joint filers, the standard deduction increased from $13,000 to $24,000. This is going to result in many more taxpayers taking the standard deduction rather than itemizing their deductions. This will significantly simplify the returns for these taxpayers. However, personal exemptions, which were previously deducted for each taxpayer and dependent listed on a return, have been eliminated. The deduction was previously $4,150 for each exemption, and this has been reduced to $0. The new tax reform law significantly expands the child tax credit. The credit per qualifying child has increased from $1,000 to $2,000. In addition, the income phase-out levels have been significantly increased to $400,000 of adjusted gross income for married filing joint and $200,000 for all other filers. This means that a lot more taxpayers will be eligible for the credit in the coming years. If you have a dependent who is not a qualifying child, there is now a $500 credit available. And of the maximum $2,000 credit per child, $1,400 of the credit is refundable. And these provisions are currently effective for tax years 2018 to 2025. Alternative minimum tax, or AMT, has been modified for individual income taxpayers as well. The AMT is a parallel tax system that requires many filers to calculate their tax bill twice, once under the rules of the regular income tax code and once under the rules of the AMT. Filers must pay whichever is higher. The new tax reform changes mean that the number of taxpayers subject to AMT will be significantly less going forward. First, a higher AMT exemption will apply to income, beginning with $109,400 for joint filers and $70,300 for other taxpayers. Also, the income phase-out levels have been dramatically increased to $1 million for joint filers, which was previously only $160,000, and $500,000 for all other taxpayers, which was previously only $120,000. In the next few slides, we will cover the changes that were made to itemized deductions for individual taxpayers. You may have already heard about the change to state and local tax deduction, as it received a lot of news coverage. The state and local tax deduction is an itemized deduction that includes state and local income taxes, property taxes, and sales taxes. Individuals will be allowed to deduct no more than $10,000 of any combination of these taxes. This will be a significant reduction in the tax deduction for those who live in high tax states, and it will likely result in additional taxpayers taking the standard deduction rather than itemizing their deductions. The mortgage interest deductions have been limited as well in the new Tax Reform Act. The Tax Reform Act reduces the amount of mortgage indebtedness on which taxpayers may deduct interest to $750,000 for mortgages incurred after December 15, 2017. The previous $1 million limitation remains in place for debt taken out prior to December 15th. Interest on your principal residence and second home continue to be deductible. Importantly, however, beginning in 2018, interest on home equity indebtedness is no longer deductible, regardless of when it is incurred. The Act eliminates the deduction for home equity interest after 2017 that is for debt used for something other than to buy, build, or improve your home. The new Tax Reform Act increases the limitation for cash contributions to charitable organizations. Previously, taxpayers could not deduct charitable contributions that exceeded 50% of their adjusted gross income. This limitation has been increased to 60%. Another change related to charitable contributions relates to donations to educational institutions. If you make contributions to educational institutions and in exchange receive the right to purchase tickets for athletic events, these contributions are no longer deductible. Again, these changes are effective for tax years 2018 to 2025. Other changes to the itemized deductions are that a miscellaneous deduction subject to 2% of adjusted gross income have been eliminated through 2025. The type of deductions in this category are appraisal fees, investment fees, and safe deposit box rent. Probably most significant, expenses related to employment, such as uniforms, professional society dues, computers used for work, mileage, and job hunting expenses are also non-deductible. The deduction for tax preparation fees is also suspended. Presumably, though, you can still make a reasonable allocation of these costs to your Schedule C, E, or F, if applicable. With the elimination of the deduction for unreimbursed employee expenses, employees who incur significant unreimbursed business expenses, such as those in sales positions, may want to ask their employer about adjusting their compensation or establish an accountable expense reimbursement plan that would allow the employer to reimburse the employee tax-free. The tax legislation repeals the above-the-line deduction for alimony paid for divorces or separations executed after December 31st, 2018. So there was no change in the tax treatment of alimony for separations and divorces currently in place, or those that are executed prior to December 31st, 2018. After that date, alimony payments will not be included in the recipient's income, and the payments will no longer be deductible by the payer. If you are currently contemplating divorce or separation, a careful review of the effects of the new law should be undertaken to determine the economic effects on your tax situation and the timing of any agreements that you might come to. Another change relates to the Kiddie Tax. Investment income of a child will now be taxed at the trust income tax rates rather than the individual tax rates. As you can see from the chart, once a child's investment income exceeds $12,500, it is taxed at 37%, which is the top individual income tax rate. It was previously sometimes beneficial for taxpayers to shift some of their investment earnings to their children. This may no longer be the case, and is worth having a discussion with your tax preparer and investment advisor regarding this. Now let's talk about tax reform changes that will affect businesses. Some of the business tax law changes we will cover in the coming slides are the lowering of the corporate tax rate to 21%, the increased bonus depreciation from 50% to 100%, Section 179 expensing limit is now set at $1 million, and the deduction of net interest expenses are capped at 30% of taxable income. Also, net operating losses are now generally going to be limited to 80% of taxable income for years after 2017. One of the new things that the Tax Reform Act put into place is a new deduction called the Section 199A deduction. It's also referred to as the pass-through deduction. This is, by all measures, the most complicated provision of the new Tax Act and is still subject to interpretation until the IRS releases additional guidance on implementing the deduction. So we'll cover the basic components of the deduction in the next few slides to hopefully give you a general understanding of the deduction. Owners of pass-through entities, which would include LLCs, partnerships, S corporations, and sole proprietorships, may be able to enjoy a new deduction of up to 20% of their domestic qualified business income. So this is a deduction that is calculated and deducted on the individual income tax return, but it is related to business income. It's not an itemized deduction, so it will be treated as a separate and additional deduction. The deduction does not reduce adjusted gross income, but rather taxable income. So the deduction is taken after adjusted gross income, but before taxable income. And the overall deduction is limited by the greater of two measures. One, 50% of wages paid by the business, or 25% of wages paid plus 2.5% of an unadjusted basis of all qualified property. However, these limitations do not apply if taxable income is less than $157,500 or $315,000 for joint returns. It is important to note that the limitation is based on taxable income rather than adjusted gross income. A lot of other deductions in the tax code are phased out based on adjusted gross levels. So this is an important distinction and one that is very advantageous to the taxpayer. And once the joint filer's taxable income exceeds $415,000, the deduction is limited to the wage calculation in the previous slide. It should be noted that some service-based businesses, such as businesses involved in the performance of services in the fields of health, law, accounting, consulting, financial services, and others, may not be able to take advantage of the pass-through deduction, depending on the taxable income level of the individual taxpayer. A joint filer with taxable income of less than $315,000 will be eligible for the deduction even if the business is service-based. However, once taxable income exceeds $415,000, the pass-through deduction will not be allowed if the business is considered a service business as defined by the new tax law. Bonus depreciation has increased from 50% to 100% of the cost of property purchased. This applies to assets acquired and placed in service after September 27, 2017 and before January 1st, 2023. This is one of the few provisions that was retroactive and went into place prior to 2018. The new law also loosened the requirement that the asset be new and allows the asset to be used as long as it is the taxpayer's first use of the asset. Also, taxpayers can use bonus depreciation to create a net operating loss. Taxpayers may now take up to $1 million in Section 179 deductions. The phase-out amount is set to $2.5 million, meaning until your asset purchases have exceeded $2.5 million, you can take Section 179 deductions up to $1 million. The Act also expands the definition of what types of property qualify for Section 179 treatment to now include certain leasehold improvements and certain types of improvements to non-residential real property. Prior to the Tax Reform Act, meals and entertainment expenses were deductible, but they were limited to 50% of the expenses incurred. Beginning in 2018, though, entertainment expenses will no longer be deductible. However, meals will continue to be deductible with their normal 50% limitation. Beginning in 2018, the corporate tax rate is reduced to a flat 21%. This rate will also apply to personal service corporations, which were previously taxed at a flat 35%. Also importantly, beginning in 2018, the alternative minimum tax, or AMT tax, for corporations has been repealed. So as you can see, there have been significant changes to the tax laws impacting both individuals and businesses. Now Brittany will talk about the changes to estate and gift taxes.
Thank you, Taylor. So as Taylor mentioned, many of these changes are expected to sunset in 2016. So if Congress does nothing to change the law again before, 2026, not 2016. So if Congress does nothing to change the law again before 2026, the exclusions revert back to 2017 law, which is $5.6 million per person. And the step-up in basis remains unchanged. So that means upon death, assets that are left to beneficiaries will continue to enjoy a basis adjustment for capital gains and tax purposes up to fair market value on the date of death of the decedent. And so that means you must use it, or lose it. The lifetime exclusion for estate and gift taxes has now doubled. So instead, for an individual, the previous amount was $5.6 million. The current exclusion for 2018 until 2025, or the end of 2025, will now be $11.2 million. And it's important to note, go back one more slide. It's also important to note that the gift tax annual exclusion has been adjusted up to $15,000 for 2018, previously $14,000. So that means that any person can gift up to $15,000 per year per individual, gift tax-free. So some important educational planning changes is that you can now maximize 529 plans. You can contribute, or what they call front load, 5 years of annual exclusions at one time. So an individual can front load a 529 for a child or a grandchild for 5 years of the annual exclusion for one person at one time. So that's for a single filer, $75,000 per beneficiary. And using portability, you can do that for married filers of $150,000 per beneficiary. So it's important to note that this would use up your annual exclusion for the next 5 years for that particular beneficiary. So you do need to coordinate this with all other planning for that beneficiary that's currently in place. Medical and education expenses are still excluded from the lifetime excluded from using the lifetime exclusion or annual exclusion as long as they are facilitated appropriately. So is estate planning still relevant? With the increase in the annual exclusion amount, this will substantially decrease the number of estates that will be required to file an estate tax return. So with few estates affected by the tax, many feel that estate planning is less important. Yet, despite the increase in the federal exclusion, it is estimated that $41 trillion of wealth will be transferred over the next 50 years. This will not only occur with the ultra-wealthy, but includes billions of dollars that will be transferred between everyday W-2 wage earners and small businesses. With the lifetime exemption increased to $11 million for single filers, it may still be advantageous for some to plan to transfer assets out of your estate during your lifetime. And as Taylor mentioned many times, it's also important to keep in mind that certain tax changes will end at the end of 2025, and these changes are not permanent. Portions of the Act have a sunset provision, and if Congress does not act before then, the exclusion amount for estates will revert back to the previous levels of $5 million for single filers. As such, many of the tax minimization strategies are still relevant, and for some, this time period may be advantageous to plan the transfer of assets during your lifetime before it reverts back to $5 million. So there are a few points I want to make about some important reasons estate planning remains relevant besides the exclusion increase. The TCJA has not changed the need for individuals to protect assets from lawsuits, divorce, or malpractice. This is important for individuals with high liability careers, such as doctors or lawyers, CPAs. In addition, it is important for clients with future ex-son-in-law or future ex-daughter-in-laws, or those on a second marriage. There are non-tax reasons to do proper estate planning, such as directing specific assets to specific persons. This provides more control, allowing you to gift assets as you wish. And for many, this is an important aspect to avoid conflict after your passing. For those who feel passionate about giving, the charitable giving landscape has changed with TCJA, making it less advantageous for some to donate annually, instead using tactics such as donation bunching or using donor-advised funds. Through the use of wills or trusts, there are also options that allow you to retain the use of assets and make a substantial gift in your future. Through estate planning, there is an ability to obtain privacy with distributions, keeping the amount of funds and receiving institutions private from the public. And the use of special needs trust or estate planning, special needs estate planning, continues to remain crucial. If you have a relative or a loved one with special needs, you naturally want to provide for them in some way. Many times this is done through a will, and although very well intended, an outright gift could compromise Social Security disability income and Medicaid benefits for this person. With proper estate planning, you can provide for the special needs person in a way that protects them from losing or disqualifying them from government benefits, while still able to receive a financial benefit from family for their care. So there are many options that remain available to handle the complex and varying estate planning needs of you and your family. It is recommended that all of your estate planning documents are reviewed, and it is always our recommendation that these documents are reviewed whenever a family or financial circumstance changes significantly, such as a marriage, divorce, birth, or death, and at least every 5 years. With the passage of TCJA, we recommend a review of your current estate plan to ensure the plan continues to meet your objectives and there are no unwelcomed surprises. Thank you, Brittany and Taylor. That was very informative. We had a few questions come in during the presentation, so let's address those now. Is planning that has been previously completed still relevant? Yeah, I can take that one. So I agree that, well, I can understand why that question would come up, but I think that with many of the changes with TCJA, it's a great time to revisit your overall financial plan with your financial planner, as well as your tax plan with your CPA. And this is important to understand the impact of your personal tax situation or business tax situation, as Taylor covered, an overall financial plan. So it really is a great time to revisit with your CPA or your financial planner to really understand that impact. Will all tax changes expire in 2025?
I can take that one. This is Taylor. Most of the provisions do expire in 2025, not all of them, but most do. But really the thing to keep in mind is that no tax law is permanent. It's always subject to change. And particularly if there's a change in the political party that's in control in Washington, D.C., if that were to change, any tax law can be changed. So it's really important to meet with your tax advisor on a regular basis, at least once per year, and make sure that any plans you've put in place still make sense and that you're aware of any tax law changes that are potentially on the horizon.
Great, thank you. If we didn't fully answer your questions or you think of another question later, please reach out to us at wealthmanagement@afma.com or to Brittany or Taylor directly. We'll go ahead and break here for now, but please don't hesitate to reach out to us for assistance whenever you need it. We do this every day for a military community, and it is our pleasure. This weekend, you'll receive a follow-up email with instructions on how to access a recording of this presentation. And you can always register for future webinars and review past webinars at afma.com/webinars. Speaking of future webinars, be sure to join us in 2 weeks when our team at AAFMAA Life Insurance presents. If you found this information useful, we encourage you to please share it with your friends and family. Our membership grows stronger every year because you introduce those in your military community to AAFMAA. Thank you again to everyone listening for joining us today. We look forward to our next opportunity to assist you.